So what happens if you go along and you're just like in a normal period of time, you miss a payment?
And you have either hundreds of thousands or millions of dollars in debt that you're not able to pay back. It's incredibly stressful.
What happens if I default on my 7A loan?
So typically, if someone misses a payment, it's typically at the 60-day mark. The loan can get flagged and transferred to special assets.
Does it make sense if you're in a cash crunch and you're thinking, I think I might not be able to make this payment? Does it make sense to do something like call somebody first before you?
Communication is the most important thing at the end of the day. I think we ended up doing over 100 million worth of express loans last year.
Hi, I'm Sarah Sharp. I'm a deal attorney who helps folks buy and sell businesses, primarily accounting practices, and this is the DealMakers Podcast episode with Eric Rabinovich of Live Oak. He's a deal maker and he's a banker, and I'm excited to hear some lessons and red flags that he has seen in this industry. Eric, could you give a little background about who you are and how you came to be involved with deals?
Absolutely, yeah. Thank you, Sarah. Thanks for having me, and hopefully some folks get a little bit of value from the conversation today. So I'm Eric Rabinovich. I'm a loan officer on Live Oak's professional services lending team, and that's one of about 40 industries that Live Oak specializes in. So myself, the team that I'm on, we focus exclusively on lending to CPAs, bookkeepers, accountants, tax preparers. To a lesser degree, there's law firms and architectural and engineering firms, but 95% of the time we're working with CPAs and bookkeepers and tax professionals. And within that, most of the deals we originate are M&A. They're folks buying other firms. There's a small percentage of folks buying commercial real estate or refinancing debt. As you probably know, the SBA program is very flexible. You can use it for all types of things. But that's what I do. I'm based in Washington, D.C. The bank is headquartered in Wilmington, North Carolina. We lend nationwide, so it doesn't matter where the customer is. And beyond that, we are the number one SBA lender. So we do a lot of these types of loans. And that's, as I'll talk about more, very relevant to today's discussion.
Thank you, Eric. And I am glad to have you on. As you know, a question that I get as a lawyer a lot and as just not the banker in the ecosystem of the deals that I do is, what happens if I default on my 7A loan? And then just kind of subsidiary questions related to that. I actually got an email this week with some questions in it about somebody who has a loan and it's personally guaranteed, of course, and they're considering buying some real estate, and they're worried about how that house will fit into the context of the collateral with the loan and things like that. But what is I think kind of hindrance to people is when you're going for an SBA loan, you don't want to ask your loan, your folks at the bank, hey, I'm really worried I'll default. Like, what happens if that happens? It's a little bit of a red flag. So I think folks want to present their most confident face when they're, which they should. So perhaps it could be of value to have more of an anonymous perspective on what happens if these deals don't go the way you hope. And I'd love to hear, just top line, what happens if you default on a 7A loan?
Yeah, so before I get into the meat of the answer, I do want to share a disclaimer, which I hope you'd appreciate as an attorney. So
love every qualifier there is.
Yeah, well, it's a very sensitive topic, right? And so I want to make clear that whatever views I express on this episode, they're my own. I don't necessarily reflect the views or the opinions of or the policies of my employer, who's Live Oak Bank, or the Small Business Administration. The conversation really is for informational purposes only and should not be considered legal or financial or tax advice. So I encourage everyone, if this is something you want to learn more about or have an informed discussion for your own circumstances, please talk with a professional or talk to your own lender if you need to. Again, we'll talk more about this in terms of, what does this look like? What should I do? Or what the options might be. But the last thing I'll say is every loan and set of business circumstances is unique. And so what I'm going to talk about today, it's really more broad brush strokes. It's not necessarily going to be very prescriptive. But with that being said, to answer your question, it really depends on a lot of different things. So, and it might be worth splitting this up into two different perspectives. One is, what can you do before the deal closes to avoid being in the situation in the first place? But then I think what you're asking is, let's fast forward. If you've already closed the deal, what does it look like? What happens if I've already taken that plunge, the loan's closed, and whatever the circumstances are, things are not going well. So the good news is there is a process in place. And so even if something goes bump in the night, the way this all works is it's not like you're immediately put into liquidation. And liquidation is generally when a lender has determined that there's a low likelihood of success for the business, and so they need to start recovery, basically the efforts to recover as much of their risk, their exposure as possible. Now, I think most people understand the SBA program, the 7A program. It's a loan guarantee program. So what that means is, as a lender, most of the time they have a guarantee for 75% of the loan. So if the bank makes a loan for $1 million, $250,000 would be their exposure. $750,000 would be what the SBA guarantees to the bank if the loan does go into liquidation. And there's a whole set of procedures and steps that happen once a loan starts to quote unquote go bad, because going bad can mean different things. Going bad doesn't mean necessarily you've missed a payment, but usually it starts with missing a payment. So perhaps we can start there. So generally what happens is if you've missed a payment after 30 days, and again, I want to stress this isn't necessarily what even Live Oak does or any other SBA lender. They have their own policies. Just as an aside, one thing I do want to make sure everyone's aware of, a document out there called I have the link here, and maybe you can post it in the show notes. Yeah. So it's publicly available. This is not, proprietary, but the SBA has available. There's really two documents I recommend everyone read before they consider getting an SBA loan. But as it relates to this conversation and this topic, there's a servicing and liquidation manual. It's about 200 pages long.
Oh boy, that does sound like everyone should read it.
It's great reading material. Keep it by the bedside. Yeah, it'll put you to sleep quickly. But it's actually the playbook that the SBA puts out for all of the lenders in the program to abide by. And it doesn't get into explicit detail per se in terms of, if so-and-so misses a payment, this is the exact thing that's going to happen, but it gives you the framework that lenders have to follow in these situations. And it goes through orders of operations. And while I don't necessarily think someone should go and read all 200 pages, when you have tools like ChatGPT and Gemini and all the others today, you can really use this to your advantage and inform yourself and prepare yourself and educate yourself in a way that doesn't raise red flags in the same way going to your lender and saying, hey, what happens if I stop paying my loan, right? That's right. You can ask them that, but
yeah, you can ask them that, but I maybe don't ask them that until you know a little bit more that's going on. We skated past so much value, and it took me a long time as somebody who was, ancillary to the lender. I'm just there helping. It took me a long time to really understand the background of the SBA and the way it interplays with banks. What I have seen is if you're not a preferred lender, it's really hard to get a deal closed with a 7A loan because they have to send it out to the government to process and underwrite. But if you're a preferred SBA lender, then you can underwrite in-house. So that was, from my perspective, one of the big things, like aha moments. And now when a deal comes to my desk, and it's, it happens a lot. Somebody says, I have a great relationship with my local bank or whatever, and they have an SBA wing. And you go, are they a preferred lender? This is so hard.
Yeah.
So I always like that. But another thing that, it took a little cognitive understanding, and correct me if my understanding is wrong, right? Because I'm kind of learning as I go along, is that, the SBA 7A loan program is kind of like the FDIC, right? It's like they went to banks and the government says, hey, it's like lending to small businesses might be a little bit riskier, but we want to encourage it because it's good for the economy. So we're going to insure these loans for up to 75%. And because of that, you have this additional assurance, you get this kind of promise, and it enables banks to go out and make the loans that maybe some of the banks wouldn't have felt comfortable championing. They would have, consolidated to the biggest companies because they're the most likely to. So it's an economic measure. Is that pretty accurate?
Yeah, that's exactly right. So I think the idea was, and they're always updating the program. There's a new set of rules. So the servicing manual that I mentioned, that's kind of on the back side after a loan has closed. On the front side, there's the SOP, right? And that kind of lays out what the criteria are for eligibility, who can get a loan, and then for lenders participating in the program, what do they have to do to vet a borrower before they close a loan? So frankly, I think both of those documents are really valuable, and not a lot of people are either aware that they exist or know how to access them. It's all publicly available information. We're all U.S. taxpayers here, so make these resources, avail yourself to them and read them and educate yourself, because it can make a huge difference, as you prepare. It's not I don't take lightly, and I think most people applying for a loan don't take lightly. You're putting a lot on the line here. So you want to know what's at stake, and you want to know, how am I going to get measured? How am I going to get underwritten? And then when the loan closes, how is it going to get serviced? What does that look like? So
that is true. I will say, and this is no knock on any bank, but having read the SOPs, one mantra that I center myself with is, it doesn't matter what I think the SOP says. It matters what the bank thinks it says. Because I have interpreted them regularly very differently than the bank, but it doesn't matter. My view is not important. The bank's is important. So there is, they're not always the most obvious interpretations, and there's a big team, I assume, of like lawyers and people, and I've been in those groups. You can all come out, you can read the same thing and come out with very different takes. So it gets you part of the way there, but it's still a little bit nebulous how it's going to be applied. So you have SOPs on the front
100%.
And then you have this operating procedure on the back end for, if there's a liquidation. So continue on. I'm glad I understand where this fits in the world.
Yeah. So going back to kind of the key question you asked, what happens? So typically, if someone misses a payment, after 30 days, the bank will likely send a cure notice. So it's more of a courtesy, but it's essentially telling the borrower, look, here's a right for you to cure the problem. The problem is you haven't paid us your most recent monthly payment that's due. And here's a courtesy notice to give you an opportunity to fix the issue. Maybe you turned auto ACH off and didn't manually schedule the payment. Maybe it's a little bit more problematic. Maybe there's a cash flow problem. Usually around the 45 to 60 day mark, if there's not a response or any kind of resolution, the loan, and it's typically at the 60-day mark, the loan can get flagged and transferred to special assets. So
that sounds so scary.
I know. And most banks have a special assets team, but essentially what happens is, for loans that are on the fritz, where payments have been missed or borrowers are not communicating, our team, the servicers, the relationship managers, we can't get a hold of someone. Generally speaking, once special assets gets involved, it's the indication that something has gone wrong, and we're not really getting, or don't feel like we're getting close to a resolution. So I guess you could think of it as a way of the bank kind of rolling their sleeves up and getting ready to try to work out a solution here, whatever that might be. Sometimes it could be, oh, I was out of the country, and maybe it's a solopreneur, they don't have a team in place, and something more just a little bit more innocuous like that, or it could be more problematic, and there's going to kind of be an escalation, which we can walk through high level what that typically looks like. So
do you recommend that missing a payment?
Well, I do not recommend it. No, I
not. But does it make sense if you're in a cash crunch and you're thinking, I think I might not be able to make this payment? Does it make sense to do something like call somebody first before you?
Yes. So one of the biggest points I wanted to stress on today's discussion is communication is the most important thing at the end of the day, because if you do not communicate with the lender, or you stop communicating with the lender, you have to understand is that the bank isn't doing this to punish anyone or doing it for personal reasons. This is all essentially a reflection of the legal documents and the legal contractual agreement. I know there's a lot of paperwork that people sign when they close a loan, but a lot of that stuff they're signing, it's not just perfunctory. There's stuff in there, and words have meaning, and a lot of those things you're agreeing to, there's in these situations, there's consequences for actions, right? So if you miss a payment and there's really no recourse, there's no communication, there's no explanation for what's happening, there's no context provided, what that does is it deprives the bank of any ability or opportunity to understand what's happening. And really what happens in that scenario where there's no communication is it drastically and very quickly limits what the options are for the bank. And that's a huge deal, because if there's very proactive communication and the borrower gets in front of issues or sees something coming from a good ways away time-wise and can tell the bank, hey, look, whatever the case might be. I mean, I don't want to generalize, but if it's going to likely or possibly result in a missed payment, getting in front of that and having that conversation with the bank, whether it's Live Oak or whoever else, it can be the difference between getting into these later stages of
special assets.
Exactly. And avoiding that in the first place, right? It is possible. And if you go through that liquidation and servicing manual that I mentioned, a lot of this is laid out there. Banks have some tools available at their disposal in terms of working with the customer to help address these situations when the going gets tough. We can make, and I'm not saying we will, or, every case is unique. And so this is not some kind of, guaranteed thing that's going to happen, but banks have the ability to modify terms. We can extend maturity dates. We can grant some degree of forbearance where there's a hold, you can hold off on a couple of payments if it allows someone to get back on their feet. Whatever the case might be, there can be flexibility. And those are options that very quickly will often just get taken off the table if no one's talking, if no one's, coming to the bank and being open. So a lack of communication is the quickest way to take something that's maybe problematic but manageable and turn it into a point, get past a point of no return, which obviously nobody wants.
Interesting. So there is kind of this balance. For me, a lot of my, this question has come up a lot before folks have gotten a loan, but on the rarer occasion that I get a call after there's a loan, it's been within the first year. I think usually, you've normalized things. The transition is really hard. It's a cash flow crunch of a time. There's a lot of anxiety about just not being able to, potentially not being able to. So the conversation I've had sometimes is, it seems like you're nervous, not you're going to miss a payment. And that is not a time necessarily to talk to your bank. If you're not actually going to miss a payment and you're just anxious about the fact that you're having to get used to this debt being on your shoulders, that's different than, okay, well, I don't know that I'm going to be able to make the next payment. I'm probably not going to, and I need to figure out something. So figuring out that gray space, but it seems like before that payment is missed, definitely call the bank and see what they can do. But I was curious, because some of the stuff that I researched in those cases was maybe the bank's position is different in the first year versus subsequent years. They particularly don't want you to default in the first year.
Yeah. So what you're getting at is probably the early loan default threshold. So what happens is in the first 18 months after a loan closes, if there's a default, then the SBA essentially conducts an audit automatically.
So the government comes to the bank and they're
they're gonna exactly. Yeah, they're gonna audit the file and they're gonna ask a lot of questions. They're gonna look at how the bank underwrote the loan. So one of the things I should mention is what's interesting with the structure of the program, with it being a loan guarantee program, and particularly in cases where the bank is a preferred lender. If to remind folks, if you're a preferred lender like Live Oak is, and most of the top lenders in the country, they can essentially underwrite, approve, and fund these loans without the government looking really at anything other than some back end, more perfunctory checks where, we're running people through ELPS, or basically making sure no one's, on naughty lists that would preclude them from getting a loan. Outside of that, most of all of the process of approving someone, it happens in-house at the bank. And the reason that's a big deal in the context of what you're talking about is the government is still providing that guarantee, right? So the bank, and therefore the customer, the borrower, is getting a tremendous benefit by getting access to this capital. So when a loan goes bad, if it's in that first 18 months, that guarantee is very much in question. It could be in jeopardy. And that's a huge deal for the bank, because what went from a $250,000 exposure could potentially go to a $1 million exposure in that $1 million example, if the SBA concludes that the bank didn't follow SOP, right? So that's why, I would say a default and going through liquidation at any point in the process is going to be a problem. But an early default in particular, if it happens in that first 18 months, it just raises more flags and there's more scrutiny by SBA. And that's why a lot of banks are particularly sensitive to that.
Okay, so that's great information. It's new to me. So essentially, if it happens in that first 18 months, it triggers this audit. And if the bank, or if the government finds that the bank didn't meet every single SOP, or they could pull their guarantee. So especially if you're in the first 18 months, you're like, work with your bank to fix
exactly.
Something. Yeah, and that's the shaky time too, where you're more likely, like some of these tools that you mentioned that might be available but certainly are not promised, like forbearance or extending maturity dates and stuff, that could have the effect, especially those first 18 months of getting you over the hump. So that seems that's super interesting. That's good information to have. So what happens if you go along and you're just like in a normal period of time, you miss a payment, or your banker works with you and you still can't make it work, and you go to special assets, which I'm imagining they all have shaved heads, and they're very intimidating. Maybe like one guy has a scar all the way down.
We recruit from recently released inmates exclusively. Yeah.
Well, I worked at a war crimes tribunal in The Hague, and there was a division that was like I'm describing. So that's what I'm picturing, is like financial diligence, and they were all super intimidating. But their job was like to go to the region and find all of the assets of these people being accused of war crimes and make sure that they repoed them, basically. So similar, maybe you could recruit from there, just like if you.
No, they're what I know they get a bad rep. It's almost like auditors, right? No one wants to hear from the auditor, but it's an important job and someone has to do it. And I feel for them, because I know most people don't probably think about the bank and the people coming after that. They view it as an adversarial relationship, but they're dealing with people who are often going through the worst moment in their lives, or whether it's personally or professionally, oftentimes both. And it's challenging work, but it's really important. But I can't stress enough how important it is to have the right people doing that type of work, because you do have to work with people who are going through often what are extreme hardships. And think about being in that situation where you bought a business, and whatever the case might be, it's not working out, and you have either hundreds of thousands or millions of dollars in debt that you're not able to pay back. It's incredibly stressful. And for us, having a team and people in place who can be patient and who can be understanding and sympathetic, but also honest and clear about what's happening. And it's not easy. It's not an easy job. I feel for them.
I would want it. Although that division at the War Crimes Tribunal was very fun. They were very nice people. But yeah, I hear what you're saying there. One thing that I constantly am curious about is, you have the collateral, and what I do primarily with accounting practices is a cash flow lending thing, as professional services firm. So it's not like you have a warehouse of accounting inventory. You've got usually $5,000 of old office furniture and a copier scanner that's probably leased anyways, and then there's just the client list. So that I've been interested, like, to what degree does the bank try to make something out of the business itself versus do they just skip straight to like hard assets? Like, okay, well, their house is on the line. We know we can take, the house. Let's get that before anybody else, any other lenders try to scoop things up.
Yeah, well, it's a challenge reflective of the industry, and as you allude to, by and large, these are professional services and businesses, so there's not a ton of hard assets, at least on the business side, right? There's not going to be much in the way of recovery when we're talking about if there's a physical office space, cubicles, some office furniture, laptops. And that's just an inherent risk of the industry and generally working with professional services firms. Now, that often, what that results in is we're looking on the personal side, right? So whether that's equity in somebody's home, if they have other assets, right? If they have, vehicles, boats, but it's kind of just a known risk that if you're making a loan to a professional services firm, there's an elevated risk that if things go bump in the night, the recovery value on the business side of things is likely going to be very limited, which is why, frankly, the SBA program is so valuable, right?
Yeah.
I think in a conventional lending setting, that would likely be a very difficult, it would be a difficult loan to get approved for. With the SBA program being primarily cash flow based, right? It opens up a lot of doors in cases where I think from a conventional lending standpoint, it would be really hard to get a yes.
I see what you mean there. That does make sense. Does Special Assets do anything with the company? I mean, do they try to call the seller and say, hey, can you take this back over? Or like, let's go with another bank?
I haven't seen that. The thing is, if whatever the issues are that are leading to Special Assets to get involved in the first place, it's probably going to make that business pretty low value at the end of the day. And so even if you got a broker involved and tried to have a fire sale or sell, some of the client list, I think the recovery value there is probably going to be pretty limited. I don't want to say it's not possible. I've heard of cases, not necessarily for accounting firms.
Okay.
I've certainly seen cases for other businesses where there's like a kind of a forced sale or encouragement of a sale. I personally had been involved in a situation where when I first started at the bank almost a decade ago, I mentioned I'm based in DC. I have a government contracting background, but there was a case where an individual had purchased a government contractor and it wasn't working out. They weren't winning as much work. I think they just underestimated the difficulty of running a business, and then in that industry in particular. And interestingly enough, we brokered like a loan assumption. So one of the things you can do with an SBA loan is someone else can assume an SBA 7A loan.
Okay.
And I haven't seen that yet for a CPA firm. Doesn't mean it can't happen.
Yeah.
But what's unique about the industry is, customers can come and go very quickly, and it's a little bit different with like a government contracting firm. Like you win a contract with the government, that's pretty much staying in place, and you can transfer it, right? You can buy that firm anyway. So it is possible. I don't think it happens very often, and so because it's all goodwill, It
is all goodwill. That's interesting, because that means, hey, you definitely want to pay attention to the personal assets that are in play here, because that's going to be the pretty much the straight step that the bank's going to take, is to get to those assets. They're not going to really wait around trying to make something of the business itself necessarily.
Yeah, but to the earlier point, the sooner that we're told that there's issues, depending on what those issues are, remember what I said, the sooner we're pulled in, the more opportunity and the more time that gives us to get creative and to work with the customer to try to troubleshoot here. I mean, there's been cases where we've assisted with bringing consultants in and helping with marketing, helping them spruce up their website, helping them I mean, again, these are all case dependent,
Yeah.
and so I don't want to say because I've seen it, it's going to happen in someone's unique circumstances, but the earlier you notify the bank that there's a challenge and we get pulled in, the more of an opportunity that gives us to help rectify the situation. The later we're told about something, or if we're just not told at all,
Yeah.
that really ties our hands and therefore limits the options for the customer as well. I think the natural instinct for a lot of people when this happens is to kind of retract and get into a defensive posture. And there's all types of other dynamics at play here. I mean, there's emotions, there's people, feeling ashamed, feeling embarrassed, and whatever it is, if it results in them going silent, that makes it really hard to troubleshoot at all, right? You can't fix what you don't know,
Yeah.
what you're not aware of. So I think once special assets gets involved, we typically will, I think it's in the servicing manual that I mentioned, we'll have to do a site visit, right? So to your question, like in those cases, we'll visit the customer and look at what's happening on the ground. Like we'll see if there are any assets in the office space, talk as much as we can with the customer face to face, try to understand what's happening. This doesn't really pertain or probably isn't particularly relevant to the customer directly, but on the back end, and this is pretty uniform, I think, across most banks, they're all going to have their own like risk grade system in place. All it is it's the way that the bank measures the risk of all their different loans in their portfolio, right? And some every day, every week, every month, loans are getting upgraded, downgraded, right? But it's a way to kind of measure the strength of that lending portfolio, and then also to help allocate resources and attention in terms of where do we need to direct resources and marshal resources to help folks where they might need help, or for the bank ultimately to try to increase the likelihood of recovery, right?
Yeah. So if you're, that's interesting. It makes sense that you would, because obviously the bank isn't going to want to make a disproportionate number of risky loans. So you're going to have certain number of ones of each rating. So the personal assets that you're guaranteeing, like the home, which is the difference if your primary residence. And how much of that can be seized is a little bit state specific. There's some states that have like a homestead exemption of 100%, right. And then there's like hilarious ones like California's homestead exemption is like for $70,000 if you're home, which like in California is a riot. Like that's not helpful to anyone. Don't quote me on that. I don't think that's exactly accurate, but you get the context.
No, but you're spot on. I think some states have like a $10,000 exception, which is
all right.
How nice of them.
Update this.
Yeah.
But if you're running your business, you have these loans already. You're living your life. I mean, they're 10-year terms, so you've got a lot of life to live in 10 years as a professional. So you're going along, you're acquiring more assets. Let's say you're buying a second home or a rental property. Are all of those additional assets going to be seizable by your prior pre-existing SBA 7A loan? Does it like get updated, or is it kind of fixed based on what you have at the time you take it out?
So, I wish it was a clear black and white answer. But I think it will depend. So what you're bringing up, and it's an important distinction to make, when you're applying for a loan, there's a couple of things I think most people are aware of if they're thinking about getting an SBA loan. One is the personal guarantee, right? So that personal guarantee is unconditional and it's not limited. It's obviously it's going to generally be limited by whatever the exposure is, but the actual guarantee is unlimited and unconditional. But that's different than an asset-specific lien that is placed on a particular asset. So one of the other requirements that I think most people are aware of, at least in the conversations I have with prospects, is SBA requires if you have 25% equity or more in a residence, if there's a collateral shortfall, you have to pledge, and again, it's an SBA rule, not a Live Oak specific rule, but if you have 25% equity or more and there's a collateral shortfall, which there almost always is with a professional services business, they have to put a lien on that property. Now, most of the time, there's a mortgage in place, right? Most people have a mortgage, so the bank is subordinate or in a second position to whoever that lender is, and that's pretty much, that's the rule. So there is a distinction between having that personal guarantee out there, which theoretically puts into play all of the assets that guarantor has on their personal balance sheet, and the actual specific lien for an asset. So the guarantee is less, because it's not tied to a specific asset.
Yeah.
There's a little bit more.
You would have to, I imagine it's less direct, right? So
exactly. So there's more that can change.
Right.
Right. The borrower could dispose of it, could transfer ownership to somebody else.
If I'm the bank, I'm going to go after the properties that there's a lien on first.
Right.
And just to use my own situation, I've had my house for a long time, so I have a lot of equity. So I have $700,000 of equity or something in my house, but my mortgage is $400,000. So yeah, they would get the mortgager would get $400,000. You guys could take $300,000, and and then the shortfall, there's that personal guarantee. But I think mechanically, you might have to go and get a judgment for you'd have to sue me and get a judgment against me, and then have the whole legal process of collecting on collateral that I own. Which is additional kind of headache beyond. So, I see what you mean. There's a group of things that are, there's a lien on that are going to come first. And then there's the general personal guarantee that goes to anything that I have kind of less directly.
Exactly. And with that personal guarantee, there's less certainty, I suppose, the bank has compared to that specific asset. In any case, what we're talking about here is typically, pretty far down the road. I don't want to generalize again too much, but a lot of times when we're getting to this point about, assets being liquidated, most of the time, I think folks have already or are in the process of filing for bankruptcy, mostly right. Chapter 7, but not necessarily just Chapter 7. So, if you're getting to this point or thinking you might be on track to get to that point, I mean, I would hope at this point you've already spoken with an attorney and
bankruptcy attorney, and you
exactly.
Yeah.
And there's even attorneys out there with specialization in working with offers in compromise with SBA lenders. So there's a whole process that you can learn more about in those cases, but it's going to be so individual, and the state you're in is also a huge factor. So
that's true. And the bankruptcy attorneys are, this is all they do. So I certainly don't dabble. And they're also sweet angels for participating in such a challenging experience that people have. Well, this has been really helpful, and I don't want to, I know it might feel like a downer to talk about it, but so I wanted to end by being descriptive about how rare this is. The 70 low program there's very few defaults. Because you do underwrite pretty conservatively. It's not it's intended to make banks a little bit more comfortable with things like professional services firms and underwriting them, but it's not like you're just throwing money at people. So
of course, yeah.
I mean, when I have tried calling around and asked, have you seen somebody default? I have to talk to a lot of people, and there's just a couple of occasions that people are all kind of referencing anecdotally. So, I mean, do you want to say anything about how uncommon it is?
Well, yeah, I mean, you can look up the default rates by industry, but I think for accounting and professionals, industry-wide, and I say industry-wide, in the SBA lending world, there's about 4 NAICS codes we can limit this to. These are the 6-digit industry codes that I think it's the
NAICS.
Yeah. NAICS stands for North American Industrial Classification System, if I have that right.
And I didn't know it stood for anything. I mean, so good.
Yeah. But there's about 4 that I'm referring to in terms of the industries that I work on. And if you just narrow the lens to those 4, I think the default rate over the last 10 years is in the low single digits, maybe 5 to 6%, 4%, something like that. And keep in mind, default is not the same thing as charged off. Those are not the same thing. So the actual, so what that means is a lot of loans that default, they stay in a defaulted status, but then they get back on track.
Right.
And so there's, recoveries made and folks, generally get back into accrual status. There's charge-offs, which are kind of the end result of a loan truly going bad, where there's a certain exposure. Maybe there's some recovery of that, whatever that amount is, but there's some loss, and then the bank will charge that off. The charge-off rate is I think sub 1%, something maybe, yeah. So to your point, it's
so rare,
exceedingly low,
yeah.
But it does happen. And so to my earlier point when we started, because we've done, if you look at the last decade, I think Live Oak has done almost double the amount of loans in this industry to the next number two, I think it's Wells Fargo. And I'm not saying that to brag. I'm really, it's more of a point of statistical probability. Because we've done the most amount of lending, we've by extension seen the most amount of deals probably that have gone bad, and we've seen the range of reasons that happen. So it's really important when folks are picking a lender or talking to different lenders, we're going to help customers be put in the best position to succeed and to avoid some of these these mistakes or lapses of judgment. Every new deal that goes bad, you learn something from it, and as a result, and this is true for every bank, they're probably going to tweak their credit policy slightly to account for that in the future, right? So that's really important, right? I think a lot of people approach getting a loan as like it's a commodity, and frankly, like whoever says yes to me, that's who I'm going to work with. And I really encourage folks, if they're getting told like from a particular lender, like here's why we're not comfortable with this deal, even if they can get a yes from someone else, I think it's worth pausing and wondering and exploring, like, why is the bank saying this? We're not doing it to be a thorn in your side. We're doing it because there's scars that we can point to in the past that inform our approach there. So that's really critical.
And that helps kind of add color to what I've experienced, where I said earlier, the SOPs, it doesn't matter what I think they say, but the credit policies are playing in there, and the experiences of the bank are playing in there. So I might say, yeah, it says you can, do X, but you guys are coming at it with a lot more experience. And also, before we close up, I wanted to make sure you got a chance to talk about the Express product that you guys do.
Yes.
Super cool. I do a ton of deals below $5 million, but a lot of those deals are also sometimes tuck-ins or add-ons or whatever you want to call them, or they're just smaller. They're below $500,000, and you guys have a great product for that.
We do, yes. Thank you. Appreciate you bringing that up. So we launched last year at the beginning of 24 our Live Oak Express product. It actually includes an SBA option and a conventional option. Most of it is SBA, but to your point, the biggest takeaway, it's for loans up to 500,000, and we can actually underwrite and close and fund in as little as a few days. Usually it's 1 to 2 weeks on average, but I've seen some close in less than a week, which is remarkable. If you know how long it takes to underwrite and get closed, so it's an awesome option if it applies to you, right? If you're looking at a smaller deal, we have a streamlined application process. There's a digital application. It really removes a lot of the friction that's there in your kind of more standard, typical underwriting timeline. So I think we ended up doing over 100 million worth of Express loans last year.
Is that right?
And we expect that probably go up by almost a factor of 10 this year. So it's a really awesome product. Obviously not the right fit if you're looking for a much larger deal, but it is it's a wonderful tool. So yeah, we'd love to talk with anyone who might want to learn more.
Well, so if anybody wants to learn more, it's Eric Rabinovich, Live Oak. Reach out, and if you found this content helpful, please like and subscribe and engage with it. And thanks for coming on, Eric. It was wonderful.
Thank you, Sarah. Appreciate it.
Take care. I'll talk to you soon.
You too. Take care.